The reaction to Tesla's Q3 earnings report was surprisingly negative from the Tesla community. And today we're going to look at Adam Jonas's report to see how the economic turmoil that is coming and that we saw Elon fears will actually put Tesla into the strongest position they've ever been in. Tesla's third quarter, a watershed warning to the EV industry. When the world's leading EV company pours that much cold water on the outlook, its competitors and suppliers may want to listen up. If Tesla doesn't grow profit in 2024, what does this mean for the EV efforts in Detroit, Wolfsburg, and Nagoya? Jonas thinks that the third quarter report was one of the most cautious conference calls ever, and he calls for a serious consideration of the implications for the broader EV complex. Because in his view, Tesla's caution should mean caution for EVs broadly. He says demand is slowing. This wasn't just any company warning on EV demand. This was the industry leader with nearly a 20% share of the global market and 50% of the United States market, who is giving us this conservative call. But in my opinion, we have no evidence yet that demand is slowing. We saw the factory shutdowns in the third quarter, and I don't think we really have a gauge on where demand is at until the fourth quarter. We see those fourth quarter delivery numbers because traffic on Tesla's website, as I've said in my previous videos, is up 59% year over year as a result of Tesla's price cuts. So they are keeping demand up and they are still growing, as we'll see in the fourth quarter, even though it is coming at the price of cutting prices. But Elon was asked on the call, is there price elasticity at Tesla? And he said yes. He says there is a correlation between how low our prices go and how much demand there is. So the path to 20 million vehicles is obviously to lower your prices. EV penetration forecasts have downside risks, and in this paragraph, Jonas basically warns us that we might not see the EV penetration numbers that we expected previously, back when interest rates weren't crushing companies. But why is it that other countries don't seem to be having the same problems with the transition as America is having? And if Trump gets into power next year, then I think we're going to see the transition slow down even more based on what he's been saying lately. Look, we can't burn fossil fuels forever, otherwise Earth is just going to end up turning into Venus. What happens is once the Earth gets hot enough, then rocks will start to emit CO2, and then that will make the Earth even hotter, and it's an irreversible cycle. It's called the runaway greenhouse gas effect, and it's the reason that Venus gets hotter and hotter every single year. Sympathy for Detroit. The timing of Tesla's warning coincides with ongoing and contentious UAW negotiations for the Detroit OEMs. One of the many considerations for the executive teams and boards of U.S. domestic OEMs is the economic viability of their previously announced and ongoing investment in EV expansion. Tesla has achieved industry-leading scale per model and stock-keeping units and is widely recognized for achieving high levels of efficiencies in manufacturing, production, and vehicle design. Yet, Tesla's auto margins are currently materially below that of internal combustion ICE products. I don't know what Jonas is saying here. I don't have any sympathy for Detroit. You can't really compare Tesla's margins with ICE vehicles because ICE is at such a far greater scale than EVs are at right now. Long term, with the effects of Moore's law, with the fact that EVs have far less complexity, way less moving parts, and that they can be designed for automation far more easily, suggests that EVs are going to be the cheaper alternative in the long term. Jonas is complaining about margins in the middle of the ramp of Austin, the ramp of Berlin, the ramp of the 4680, the creation of Cybertruck. Tesla is doing this to themselves. They're choosing to have low margins. It's a strategy play. ICE is nice, an overdue recalibration of legacy OEM EV targets. We expect to see the Detroit OEMs bring greater attention to the attractiveness and profitability of their ICE portfolios, while at the margin, de-emphasizing their EV plans. This process has already begun. Pushed out EV capacity expansion. Tesla CEO Elon Musk says the company will wait to see how the global economic and interest rate environment plays out before going full tilt on its Mexico expansion. This is significant given that primary purpose of Giga Mexico was to accelerate the commercialization of a more affordable sub $25,000 EV. But we've already learned that the first line and the inception of the $25,000 EV is going to be at Giga Austin, not at Giga Mexico. So what is Jonas trying to say here? The primary purpose of Giga Mexico? Yeah, that's old news. It used to be. Now it's going to be built at Austin, and they've got like 2,000 acres of land still at Austin. They could do everything there. For them, it's a matter of personnel. There's only 2 million people in Austin in terms of population. And so while personnel are willing to move to Austin, there's only so many homes that can go around. It makes more sense for them to do the $25,000 EV there, though, because they have all their talent in Austin. And so they can get the lineup running faster than if people have to go to Mexico back and forth. It just doesn't make as much sense. It's probably a wise decision, though. And Elon has PTSD from 2009 when he was, days away from Tesla going bankrupt. And we saw GM and Chrysler go bankrupt. And things are going to get a lot cheaper after everything plays out. You're going to be able to scoop up factories for pennies on the dollar. Not that Tesla will ever, go that route because they like to design their own factories, but any building will be cheaper. Our overweight ratings on Ford and GM are underpinned by our expectation that both firms will move the needle towards capital efficiency and austerity. We expect continued EV investments in Detroit, but at a far lower rate than projected. We see potential for lessons learned from the oil and gas industries on the topic of capital discipline. So Adam Jonas, liking Ford and GM, he's got overweight ratings on those stocks as a good short-term play as they refocus on maximizing their ICE businesses. Of course, in the long term, this is going to look good for Tesla. Let's keep reading. Negative implications for the EV supply chain. And this paragraph basically touches on the concerns for OEMs and how, with them slowing their EV ambitions, their suppliers are going to be feeling that wrath, and then they're in turn going to slow down too. And it's just going to paint a more gross picture for the long-term EV transition for OEMs, because the reason this isn't a concern for Tesla is because their suppliers are almost completely indebted to Tesla, in the sense that almost all of their business is Tesla. Tesla doesn't have a lot of suppliers that also supply GM and Chrysler. And I don't know if I already said this, but we can attribute that to Larry Goldberg's extensive research in that space. And so then Adam Jonas goes on to say, financial returns of competing EV projects in doubt. If Tesla struggles to generate a 5% operating margin for its EV products with US workers making $45 an hour, what's the EV margin outlook for Detroit OEMs whose EV workers may potentially earn closer to $100 an hour in all-in comp and benefits? It's worth remembering that Tesla is widely seen as the low-cost EV producer in the West. The wording here bothers me a little bit because I don't think Tesla is necessarily struggling to generate a 5% operating margin. I think the proper word would be that they are choosing to generate a 5% operating margin, because there's no doubt that if Tesla wanted to keep their prices high, they could have, and they could have maintained that margin. Would they have sold as many EVs? No, but they still could have kept that margin up, and they could have sold a couple more EVs too if they had advertised, but they're choosing to make it a difficult environment to enter for competitors. They are choosing to expose more customers to the brand, and it's really a long-term play, because eventually, as Tesla ramps up their compute and they ramp up those software sales, that 5% margin could easily do a 5x once the utility of their vehicles does a 5x through FSD. So we're going to see all of these companies dial back their ambitions and focus on those juicy margins on their ICE vehicles. And then all of a sudden, Tesla's margins are going to 5x, and they will have wasted all of their time. Government ICE bans looking increasingly unachievable in our view. The state of California wants to ban the sale of ICE vehicles by 2035. Of course, such bans must consider the ability of the supply chain, efficacy of the electric grid, and economic viability of the U.S. manufacturing base to fulfill such a goal. In our opinion, the gap between EV policy targets, the ability for industry to deliver such targets, and the ability of consumers to afford such targets is looking increasingly distended. I certainly disagree on the last point, that the ability of consumers to afford such targets is looking increasingly distended, as we've seen Tesla cut their prices over and over again, month after month, down like 21% this year. It's looking more and more like consumers will be able to afford EVs, and that's what makes Tesla's story so exciting. The gap between EV policy targets. I mean, they're giving us big targets, and a lot of the OEMs aren't able to keep up. They're not even able to pay back what the government is giving them. And the ability for the industry to deliver such targets is also in question at OEMs. They're dialing back their projects. You have the union asking for more money. They're starting to focus on ICE operations. So this is really Tesla's world in the USA, and I expect them to keep their 50% market share for several years And I also expect the regulatory credit sales to continue to grow as these other companies focus on their ICE vehicles. They are going to have to purchase those regulatory credits from Tesla. And that is a portion of revenue that analysts thought was going to be completely dwindled by now as the competition kept coming. But now Tesla's going to have a huge portion of money coming from regulatory sales over the next decade, it looks like, based on how many EVs these competitors are producing. We see Tesla's incrementally negative outlook as a sign the company wants to err on the side of caution to protect the house at a time of elevated macro, consumer, and geopolitical risk. At various times in Tesla's history, the company's strategy has swung from offensive to defensive. The current tone has clearly shifted to the latter. While the reset may hurt shares near term, we believe this may prove to be the right strategy for the company and its stakeholders over the long term. And like I said, Elon has PTSD from 2009, and his CFO seems to be on board with Elon's strategy there. He's willing to cut prices and he's willing to continue to invest in AI. And as Tesla enters this storm, along with all of the other companies, I think they certainly have the biggest and the strongest ship. And from what they told us on Q3 earnings, they are reinforcing the walls of that ship right now. And what's so exciting to me is as this storm brews and gets more chaotic and ships are tossed around, all of the ships around Tesla are going to be just fighting to stay afloat. But Tesla is just going to be inside their ship, hanging out, working on FSD, ramping up their compute, continuing to increase their energy margins. They're not even really worried about what's going on outside, but they're not going outside. And what I mean by that is they're not focused on growth at the moment. They're just hanging out in their ship so that when the storm's over and they can come outside and interest rates are back down, their vehicles are going to be 10 times more useful than everybody else's vehicles. And they're going to come up on the deck and look around, and a lot of those ships will have sunk. And the ones that have stayed afloat will have spent the last 3 or 4 years just trying to stay afloat and not investing in R&D and not investing in AI as Tesla has been doing under the deck. And so I think with this, period that we're going into, this economic turmoil that's coming, is only going to advance Tesla's lead larger and larger. And it hurts. I mean, I've actually got to sell some shares within a month here just to continue to fund what I'm doing here because I'm taking a risk. And so I'm going to have to sell some Tesla stock to continue to do this as I'm not profitable enough yet. So the Q3 earnings report hurts in the short term as somebody that has to sell shares. But if you're somebody who doesn't have to sell shares this year, well, I don't think you have anything to be worried about on the Q3 earnings call because from a long-term perspective, nothing changed about the strategy. And if you divide Tesla's business into 3 segments, you have automotive, you have energy, and you have AI. Well, on the AI front, we got great news. We got news of FSD miles driven. We got news of 10,000 GPU clusters coming online faster than anyone's ever done before. And in the energy business, we're seeing an unprecedented rise in margins. So the energy business is on pace to just completely be on par with the automotive business. It's now generating $500 million per quarter in profit, and it's growing fast. I mean, the Lathrop factory is not even fully ramped, and the China factory for Megapacks is about to come online. The auto business is struggling, but that's just one of 3 major businesses for Tesla. Sure, it's the biggest piece of the pie right now, but Tesla's betting on software margins. And so a lot of people are giving their take, and a lot of them are negative right now. But if you have a long-term mindset, you should not be worried in the slightest about Tesla's future. So good day, everyone, and I'll see you tomorrow.